What's up, guys? How you doing? I hope you are doing well. Good to see you. Welcome to Vinel TV. If you are new to this channel, and if you are, please consider subscribing. Give this video a thumbs up. If you like what I'm about, please hit the subscribe button so that you get notified if we upload more videos. Without taking further ado, I thought to speak to you guys about how to not to invest in stock market, whether in Nigeria or anywhere across the globe. Investing in stock market is something that you need to do your proper research, do your due diligence, trying to find out exactly the type of investor you are. Done the research. I wrote some things down that can help us, going forward, what you need to look out for just to minimize the risk, because one thing you need to understand is there is always volatility in the market. But if you know what the type of investor you are, that will kind of help you, to navigate the storm, like I call it. Okay, so I wrote things down, in terms of what we need to discuss, how not to invest in stock market anywhere across the globe, things that you need to look out for, things that you need to do to help you navigate the storm in the market. Okay, so I wrote things down. Here is things you need to think about. The topic for today is how not to invest in share in Nigerian stock market and others. Whether you are investing in New York Exchange or FTSE 100 here in London or France or Dutch, anywhere, or Dutchland, right? One thing you need to think about is, first of all, you need to find out the type of investor you are. You need to know what you really want to do or what you want to achieve in terms of building your financial portfolio, and how you want to work yourself in the market. So things I've kind of realized in terms of being what is helping me or what I do is just to make sure that do not enter stock market and exit stock at will without fear. I know that they say that you shouldn't really be fear, but daily you need to do calculative risk. You know what I mean? So do not enter market and exit stock market at will. You need to give your portfolio time to grow. You need to invest in a long run. Some people, obviously, some people do come into the market and trying to make instant profit, so to say. But from all the ideas and principles there, all the people who have been into investing for a long run will tell you, what actually matters in stock market is for you to be there in the long run. It's not about chicken in and chicken out. So this is what I'm saying here. You just do not enter and exit stock market at will without fear. Because if you're entering stock market, you are paying VAT, you're paying the fees, to get in there. You're paying the stockbroker, you're paying the stamp duty, you're paying a lot of funds, really, to be able to buy a share. Okay, the same thing is applicable when you are selling the share. Also, you are paying a lot of money to the stockbroker, to the Nigerian Stock Exchange fee, and VAT, value added tax. These are the things you need to think about. Okay, the more you go in and chicken out, so you incur fund either way. So you incur fund, by selling to whoever want to buy your share, but also you incur fund, by buying, the shares to somebody or from somebody else. So the more often you do this is not to your own beneficial, so to say. It's something that you need to think about, trying to give yourself enough time, but also you need to find out the type of investor you are. So what I'm saying is, please do not enter and exit stock market at will without fear. I know people say, oh, why should you shouldn't really be fear? You need to have courage to invest. You need to do a calculative risk. Stock market is something that you need to do, check the principle, the fundamentals, but you need to find out the type of investor you are. That is the main thing. Okay. The other thing is you need to don't invest in stock market or stock that you hardly know. Okay, if you hardly know the company that you are buying, what they do, well, you shouldn't really buy in that company. You shouldn't really buy in their shares, really. If you are buying a company that you don't know anything about at all, you don't know anything, even any single information about that company, why should you do that? Why should you want to waste your money? Investing in stock market is you need to know that company inside out. You need to know that company. For I give you an example, it's like investing in Dangote Cement in Nigeria. If you don't know anything about Dangote Cement, if you don't know what they do, there's no point in investing in that company. You need to know the company inside out. You need to know the management team. You need to know the owner. You need to know actually how many shares they got. The shareholders in terms of the member people who own that company, the highest, the large shareholders in that company, and see if they're buying more of share of that company. That will kind of give you idea. So you need to know the company you are buying, know what they do. So trying to know the company that you are buying, know what they do. So if you are buying MTN share, for instance, MTN Nigeria, MTN is a telecommunication company. You need to find out, how long they've been in the system. Do your own research, do your due diligence, find out what that share actually worth, and see if it is high in the market or not. Whether it's on the low side or is on the high side. This is how to do it. You need to do your own research, think about where that company is, whether it's in telecommunication company or whether it's industrial company or whether it's in the banking or banking and finance, or whether it's in whether into the insurance team. So you just need to find out what that company do inside out. Try to know that company completely. For you to be able to know exactly what that company was, you need to try to find out what the share value of that company, in case if somebody want to come and buy, somebody with knowledgeable information want to come and acquire the whole company, what is that share what? Recently somebody Fort Oil, Otedola sold his shares, Fort Oil, to another investor. Another investor that came in, bought a large, I think over 75% of that shares to Otedola, Femi Otedola. And now that you need to find out what actually is the share price of that company. Sometimes the market can be not favorable to shares, but actually if you know the company inside that, what that company worth. This is something you need to think about. Number 3 is do not enter stock market with I don't care mindset. Please, whatever you do, don't enter into stock market and doing I don't care mindset. I don't care mindset is you don't care whether you make a profit or not. It shouldn't be that. It shouldn't be the case. You need to go into stock market with full, different mindset. Really, different mindset is you need to find out the type of investor that you are. You need to find out really, what you want to achieve. It's something that you want to be there in the long run, because the longer you are in stock market, the more you get some benefit in there. Especially if you buy a dividend paying stock, you can use the dividends you get from that company and buy more of that share. From there, your portfolio will be growing. There's something called compounding. Compounding is when you buy a stock, for instance, of Dangote Cement for 150 naira, and Dangote sometimes declare 10 naira dividend. Depending on how many shares you got, you can use that and buy more of Dangote Cement. And Dangote, they pay dividend twice in a year, so to say. So it's something that you need to think about. try invest in the stock market with eyes wide open. Your mindset need to be superb. You know, you need to think about exactly what you want to achieve, you know, and have that in mind. Is a long run. You know, you having that long run mindset, it will help you to navigate the volatilities. It will help you to, you know, insulate kind of your portfolio from shock. Okay, so that's something you need to know. The other thing is, if you don't understand the underlying principle, do not go there. If you don't understand the underlying principle of that company, do not go there. If you don't know that company inside out, do not. You can't be taking that risk just, you know, thinking, you know, let me put that money there. You know, if it work, it work. If it doesn't work, you know, it doesn't matter. No, you need to do things as somebody who is learned, who is in intellect, who is, you know, who have the vision of what you want to do. Okay, so you need to understand the underlying principle. You know, underlying principle I'm talking about, you need to try and find out the type of investor you are. You know, the type of investor you are will determine a lot of things. Okay, the type of investor you are will determine a lot of things, and it also will determine the underlying principle. If you are growth investor, we have actually two main type of investor, or more than. But, you know, ideally, you know, either you're a growth investor or value investor. The growth investor are people who, you know, they buy high growth company, you know, company that appreciate in value easily and often. Okay, but also the other value investor are people who buy shares based on, you know, shares that have high intrinsic value. You know, that what that means is stock that are where we're undervalued. You know, stock that are perceived to be undervalued. If you go to the market, what stock market is actually, you know, the price in the market, that does not determine exactly what the price of that company is. What stocks are being sold, you know, in the market, or the price of stock in the market is actually, sometimes it's not actually the value, the real value of that company, because there's ups and downs in market, and there's a lot of things that make that stock to be ups and down, or bring about volatility in the market. You know, government policies, right? Any news can influence, you know, the volatility, or whether it goes up or down. A company's action, company can declare dividend. From that, you shoot the share price up. If company have a bad news, that bad news will influence the price of the share. Sometimes, if America, you know, talks about, you know, any news, or sometimes, you know, even President Trump can do some send a Twitter message that will have effect on stock market abroad. You know, you remember the time when they were thinking about, you know, issue with China in terms of value added tax, you know, in terms of, you know, business plan, you know, putting the goods coming from China to US up, you know, in terms of the VAT, or what they will be paying. The same thing is applicable, you know, whereby America or Chinese are putting a goods that are coming from United States America to China up, you know, so they will pay value added tax and stuff like that. So I just want to tell you that, you know, you need to think about, you know, what the company is actually, you know, does, you know, what the company is producing, you know, trying to see if the company is, you know, basically undervalued, you know, because you need to find out exactly the type of investor you are. You know, what the art of value investing is telling us how the world best investor beat the market. It will tell you, first of all, you need to, people like Benjamin Graham's philosophy is, he believed that there are two value of every stock. Exactly, that's what I'm saying. Two value of every stock is the value it is in the market, but also in the intrinsic value, what actually that company really worth. If somebody that is knowledgeable, or somebody knows the company inside out, what that person want to pay for this company, or what you get from that company after they have offset all their liability, after they have taken off all their liability. If the company is sold completely and take off their liability, people that own money, stuff like that, if you taking that off, then you see exactly how much money left divided by the number of shares that company got. That is how you to do it. So I want to read this to you, just a quick one. Philosophy from Benjamin Graham, he believed that there are two types of value investors, or value of every stock, right? The first being the current market price. So the current market price, what that stock is being sold at the market, or the actual price it is at the market for that particular day. Okay, and the second one is what the share will be worth if the entire company were acquired by a knowledgeable buyer. So the second one is what that company will worth if they're selling this calculator in the market for 10 naira. Okay, and the actual price of this calculator is determined by a lot of things. It is determined by the market price. It's also determined by the news that's affecting the company that produced this calculator. So, or it affects by the government policy, so to say. So you need to find out exactly what that company really worth after it offset all the liability and everything. So people that go for intrinsic value, people that go for value investor, they believe, they go for intrinsic value, argue, they buy the share when it's very low, and they buy it, when it's low, but also sell it when it's high. So they go and buy a share, that might be selling 50 naira or 50 kobo, or for instance, or 100 naira in the market, whereas the actual price of that share will worth 300 naira. There is loads of them. You just need to do your own research, do the fundamental check for the company you want to invest in. Do your own research, and once you've done that, that is how to navigate, that is how to invest in stock market, because you need to get the fundamentals right. And if you get the fundamentals right, then you need to know the type of investor you are, what you want to achieve, whether it's something that you want to achieve within not something that you achieve within 6 months. It's something that you give yourself enough time, 5 years, 10 years, because the longer you are there, the longer you get the benefit. The longer you're in the market, the longer you get the benefit. Because if you are buying a dividend paying stock, every quarter or every 6 months, you get something that will help you. There's this saying from Tesco here in UK, we tell you every penny counts. And every penny counts indeed, because you need to protect your portfolio. You need to protect your money, really, your investment, really. You need to think about the type of investor you are, and making sure that you're buying a dividend paying stock that with good fundamental that will leave you, but you going into a store that will got a good fundamental, very low and cheap, you can buy it today and keep it. You are getting dividend. Recently, Zenith Bank proposed 2 naira 50 kobo dividend. It's something that you can think about. You're buying Zenith Bank, you know that they pay the dividend all the time, and that dividend 2 naira 50 kobo is at about 12%. 12% in terms of investment. That's about 12%. So what I'm trying to say is, you need to find out the type of investor you are. Do your due diligence. Buy a stock that is very low compared to what it is in the market, and stay there in the long run. Stay there for a longer period of time, and to gain the benefit. Because the longer you are there, the longer you insulate your company, the longer you protect yourself from the volatility in the market. The longer you are in the stock market, the longer gain you make, because the share will be appreciating in value, but also you are getting dividend. That dividend is also helping you. If you are in a company for a long period of time, 15 years, 20 years, I bet you what you bought that share in 15 years time is not what it is at the present time. There used to be a time when Dangote cement had been sold 50 naira, 20 naira, but now it's 150, 170, 250 even. That is tell you, how market is. There was a time when GT Bank was 10 naira, 15 naira, but at the present time is 20 something naira. The longer you're in the market, the longer it will appreciate in value. Okay, guys, I thought to speak to you about, how not to invest in stock market, what you need to do, and how, the world best investors beat the market by making sure that they go to value investing, go into stock that with, with high intrinsic value. Okay, what that means is, you buying a stock, like I said, that is very undervalued at the present time what it is in the market, but it will be beneficial to you in the long run, because you know the company inside that. And how you know the company inside that is by doing all the financial analysis, technical analysis, analyzing the company, reading the financial statement, checking all the liabilities, checking out everything about, what the company is actually worth. You need to know the company, the management team, know the company inside, like at the back of your hand completely. Okay, and don't chicken in and chicken out. Don't go into the market just to have this mindset, oh, I'm going there in 6 months time to hammer. It doesn't work in that way. You need to go in, give yourself a long time, stay in the market. People that beat market, stay in there. You need to be in the game fully, immerse yourself in that game. You need to be in that stock market, to reap the benefit. And the benefit I'm talking about is for you to stay there. It's sort of have this mindset that you are going there for cash flow. You going there for cash flow is you getting a dividend is also part of cash flow. Because every year, for instance, I get a lot of dividend for several companies in Nigeria. Every year money will flow into, from March, to June. You get in. I'm telling you now, Zenith already declared dividend. United Capital declare dividend. The same thing is applicable because they need to do this before end of March. They have 3 months after end of financial year to declare their dividend. So we are still in April. So by end of March period, you will see all this company, all the company's actions. They will be giving this information to Nigerian Stock Exchange, how they did, and whether they declare dividend or not. Because not every company pays dividend to the shareholders, but it's about the management team. If they did well, they can declare the dividend to the shareholders, and still, but that also give you clue, where the company is, because majority of the company that pays dividend also shows you that they're in good financial position. Okay, guys, if you are new to this channel, and if you are, please consider subscribing. Thank you very much, and God bless you. Stay tuned. Bye.